Hello everyone, welcome to PwC Tax Bite podcast series. My name is Pieter and I'm very happy that I can welcome you to this next episode. It's been a little bit since the last episode that we recorded, but we are back here because a lot is moving in the international tax space. And today I particularly want to talk about Pillar 2, G7 and US tax policy. And for that I have with me Evie Geerts, a partner in our group here in Belgium, focusing on the US Pillar 2 international tax, so the right person to have in this recording studio, and also Maxime Allard, director in our team, focusing on Pillar 2, connecting that with the complexities of the compliance around Pillar 2. So I would say the right people in the room to have a discussion on this. And the reason I wanted to issue this podcast is basically the G7 statement. As many of you have probably heard, there was a statement of the G7 on Pillar 2. And this is going back to the enactment of President Trump, the statements, the withdrawal from Pillar 2 by the US, and then in the past months, the discussions around imposing Section 899, a kind of huge pressure in the US legislation to come to an agreement with US and the European Union to solve the tensions on Pillar 2 and the uncertainties around that. And that ended then in this statement of the G7, initially announced on social media, formally published on the 28th of June. And this G7 statement basically puts forward an agreement to come to a side-by-side system on Pillar 2. And in this podcast, I would like to explore a little bit what this all means and what the impact is for Pillar 2. First of all, a side-by-side system. What does it mean? Well, it means that US multinationals will be exempt from the Pillar 2 income inclusion rule. So the rule that basically, from a headquarter perspective, taxes the entire group under the minimum taxation, and the UTPR. And UTPR is the rule basically that taxes a headquarter or a group which is not subject to Pillar 2 rules by members, countries, part of that group that do have the Pillar 2 rules. So to put it simplified, the UTPR basically is a rule that allows non-US countries to tax the profits of US multinational groups if the US has not implemented Pillar 2, as is the case today. So this is basically the side-by-side system. Pillar 2 rules would coexist with the existing US rules, and they would be seen as equivalent, supporting the international tax system. The US has withdrawn from the Pillar 2 discussions, but is collaborating constructively with the OECD. That's also part of the G7 statement, a commitment to resolve any remaining issues in a collaborative way. But I want to explore a bit the principles of this agreement before we dive into the impact. And there, Evie, maybe there are 4 principles. I think the first principle is that US parented groups would be excluded from the income inclusion rule and the UTPR on their US and non-US profits, because the US has equivalent rules according to the statement. Can you elaborate a bit? What are these equivalent rules in the US on minimum taxation?
Sure, Peter. They are clearly talking about GILTI, which is obviously known as being the blueprint for the IAR and the Pillar 2 rules as such. It was introduced in 2017 as part of the Tax Cuts and Jobs Act. It's a bit of a complexer system, but it basically is similar to an IAR in a sense that it looks down and taxes the subsidiaries and activities underneath up to a certain amount. It is a credit system, but the big difference with what we have under Pillar 2 is that it is based on global blending, so not jurisdictional, as we have under Pillar 2. So that is, I think, the main difference. That is also the reason why GILTI was not a qualifying IIR when the Pillar 2, or not considered a qualifying IIR when the Pillar 2 rules entered into force. Currently, under the One Big Beautiful Bill that was passed to Congress and is now on the desk of the President to be signed, the effective tax rate under GILTI would go up to 14%, but again, that is not the same as the 15% that we have under Pillar 2. So there are quite a large number of differences. Guilty is also a credit system, so there are baskets of foreign tax credits, so it's quite a complex calculation. But needless to say that there are a number of substantial differences. Then the US obviously also has BEAT, the base erosion tax, basically, if your intercompany payments, apart a number of exclusions linked to costs and low value adding services, are not taxed to a sufficient amount in the US, there's also an increase in your tax rate. And then the US also has a alternative corporate minimum tax, which is not equivalent to what we know under Pillar 2, but those at least guilty, and then potentially a combination of those other rules could potentially be seen as coming close to the goal of what we want to achieve under Pillar 2.
Yeah, thank you. So indeed, guilty, main rule, BEAT, and some other aspects of the US tax system. Now, a second principle of this G7 statement was the common objective to achieve a level playing field. So I understand, as you explained in high level, there are a lot of differences probably between guilty and IAR, but one key principle is, of course, the blending, the global blending versus jurisdictional blending. Maybe we can dive a bit into that. First of all, Evie, I think this can have a huge impact on the effective pickup under Pillar 2 or guilty. There's a big difference, global blending, jurisdictional blending. So maybe you can explain that a little bit, but also, how can that be solved? Because it's like a fundamental difference between the rules.
Yeah, happy to, Pieter. If I give a simple example, and again, oversimplifying here, but under the US system, if you, for example, today operate in, I'm going to take Dubai as an example, with currently a 9% corporate income tax, under the IIR rules, as we know them in Europe and in Belgium, you would have a pickup until Dubai, for example, introduces a QDMTT or a DMTT as they're planning to come up to the 15. So you would have a pickup if you have that same entity in the mix in a group underneath the US. It could be the case that there is no pickup. Again, the US calculation is far more complex than just saying, you have that entity and there will be no pickup. But with the global blending, depending on how the other entities are taxed and what their rate is and how it comes together in the credit system, there could be a situation where that there is no top up for that 9% that you, for example, have in Dubai. So I think that is a very important difference between the two, and potentially something to consider in the bigger scheme of things. It is clear that the US will not change its rules. And that is where we are to do today, and that is also very clearly mentioned in some of the executive orders and some of the press around Pillar 2 on the US policy side. So then the question is, Pieter, what will the inclusive framework, the OECD Europe, because we have that directive in place, where if we want to make changes, we need unanimity. What will we do? Will we evolve? Will we change the rules? Or how do we make sure that is indeed a level playing field?
Yeah, indeed, an important question that will have to be still fleshed out in the coming weeks and months to come. And of course, for the audience, it should be very clear that G7 is not the same as the inclusive framework. G7, 7 countries compared to the inclusive framework, including many other European countries, developing countries. So let's see what that will happen. A third building block in that G7 statement is about the concern that the Pillar 2 rules result in significant compliance complexity for taxpayers. And here I think a point on the table is the introduction of permanent safe harbors. Maxime, permanent safe harbors are important for taxpayers. At this moment in time, what I hear is that we're not landing yet on permanent safe harbors. That's somewhere for October, November, most likely. But based on you see, Maxime, what are the different flavors in the discussion there? How does it evolve? Can you elaborate a bit on that?
Yeah, sure, Peter. And good. Yeah. Hello to everyone. So indeed, I think that third building block is an important one because it materializes, I think, the fact that there is a lot of complexity and a lot of compliance complexity around Pillar 2, and it is clearly technical, and both I would say groups and tax authorities as well have raised concerns about the compliance burden as such. And this building block is an interesting one in the sense that it includes a shared goal, in my view, to simplify the rules as such. For example, it can be through a standardized forms, for instance. It can be clearer guidance as well. But as well, as you mentioned, Peter, on permanent safe harbors as well, on which OECD is expected to land anytime soon. But of course, I would say that the clock is ticking, and it becomes more and more important now to be able to land on something, given the political landscape as such. And I would say that it becomes as well more and more important for smaller jurisdictions, for groups as well, with limited resources, right? Because Pillar 2 needs to be manageable in practice, and that's what we are all looking for. So those permanent safe harbors are important, extremely important, but unfortunately, OECD has not landed on that yet at this stage.
No, indeed. I think we see two camps there. So on the one hand, countries that really want to go for maximum simplification. I can only guess that the US would be part of that camp, where they want to, as much as possible, go to simple rules like the transitional safe harbor rules. You look at data points that are already available for taxpayers, not burdensome to collect, and that give an indication on the effective tax rate. While other countries are really saying, for permanent safe harbors, we need to take into account purchase price accounting. We need to make some fundamental corrections to the data just to make sure we end up with a reliable estimate of what the Pillar 2 position would be and the minimum tax would be. So to be seen here where that will end up, but clearly they have not landed on this yet. And so this was the third block. So we had already the level playing field, the compliance, the simplification, the fact that US headquarter groups would be exempt from the IAR and UTPR. And the fourth block, Avi, also seems for me an element which has been inspired from a US perspective, and it deals with non-refundable tax credits and a solution that should come from it. What is the problem with non-refundable tax credits?
Yeah, Pieter, and it will not come as a surprise that this is indeed linked to the US, because as you might recollect from a while ago, the credits under the Inflation Reduction Act that was introduced under the Biden administration were ultimately seen as refundable credits for Pillar 2 purposes, but most, if not all, of the other credits that are existing in the US are non-refundable. And basically, that has been something that's on the agenda of Treasury in the US for a while. They want a solution for this. And generally, there's also said that if the US, with a 21% corporate income tax rate and state and local taxes on top of that, would dip below the 15% effective tax rate, that it's often due to the use of those non-refundable credits. So they want to look into, I think, revising those rules. From my perspective, also one that is important in a European context, Pieter, because also in Europe there are not that many refundable tax credits. It is also obviously a tool to attract foreign direct investment in the future if you can, as a territory, have sufficient cash to make them refundable. So in general, not bad to open a discussion on this one for businesses. Yet again, a potential change in the rules. So we will need to see where that lands. But obviously, there's a clear incentive on the US side to look into this. If, for example, you would be a Belgian headquartered group with US subsidiaries, depending on how that side-by-side system would look, I think we cannot exclude that there would be some pickup under Pillar 2, and it's potentially that they want to avoid. But again, we need more details. It is just a statement, but it's clear that there is on US, but also on European side, an element to look into.
Yeah. No, thanks, Evie. So I think, what do we learn from this? Well, I think if we put on the US glasses to this statement, it's clear that the United States are interested to make sure US multinationals are not subject to Pillar 2. Should the profits of US multinationals should not be taxed by by other countries than the US, and the Pillar 2 rules should be as simple as possible, reducing the compliance burden. So I think that is a very clear perspective. If we look at it from a European perspective, what does it mean? Well, in Europe, we all know there is a Pillar 2 directive, and this Pillar 2 directive should be executed by member states in Europe. So if the Pillar 2 directive requires to implement the Pillar 2 rules in a certain way, and in the end, a global deal requires different Pillar 2 rules, the Pillar 2 directive, in my view, would need to be adapted to ensure legal certainty. And if you look at the Pillar 2 directive, it's very clear that the directive proposes jurisdictional blending and not global blending. So changing that would require the directive to change. There are definitions of what is a qualifying tax credit, and it's only refundable tax credits according to the directive that qualify for Pillar 2. So again, there, clear opposition with the European directive. And I can go on with this. If I match the G7 statement with the directive, you come across various points where there is a tension. So it's clear from European perspective, a key question will be, how can we change the Pillar 2 rules and adopt a different directive, knowing that unanimity is needed to change the directive, to withdraw a directive. You can see there will be also a political discussion within the European Union on this. But then if we also look from maybe developing countries and other countries, non-European, non-US countries, these countries will be confronted with a G7 agreement to which they are not a party to. And they may wonder, well, if the US is not subject to UTPR, why should our multinationals be subject to UTPR? So I think there an interesting development to monitor is the reaction from those countries to this G7 statement and how they will react within the OECD to come to a change in the rules. So I think this will be very interesting in the coming months to see. And I think also on the QDMTT, an important discussion will occur. Because of course, the QDMTT is the ability for countries to tax companies, part of a multinational group, in that jurisdiction already under the Pillar 2 rules. And so to grasp the benefit of the tax in the country itself. I think from this perspective, Evie, also from a US perspective, there can be interesting discussions there, I think, on the allocation of taxes under QDMTT. Maybe that's something you can share with the audience.
Absolutely, Pieter. Not in the G7 statement, but a while back when the discussion started on Pillar 2 and US tax policy. So after the executive order of President Trump on Inauguration Day, it was said that the US would want the QDMTT to optionally allow credits of CFC taxes. So yeah, in the US context, likely then meaning guilty in the QDMTT calculation. Meaning obviously, if you would look at it from a QDMTT territory perspective, that you allow a CFC charge in your QDMTT calculation so that your QDMTT tax as such would likely be lower or non-existent. But also making it even more complex than it already was. So the question will be, is that something that they want to reinforce as part of the deal with the G7, or is it really limited to IIR and UTPR, which is set in the statement? And are there territories that will deviate, as far as my understanding goes, Pieter, if they do that, if they allow CFC credits in the QDMTT calculation, they are non-compliant with current Pillar 2 rules, and it would not be a qualifying domestic minimum top-up tax. So to be seen also from that perspective, whether the US pushes this through, whether it's part of the deal they want to make, or whether they leave that one on the table. We don't have a lot of details yet, apart from the fact that a couple of months ago it was stated as a wish on the US side.
Yeah, and this triggers an interesting question in my mind because, so it's interesting to know that the QDMTT principles could also be still adapted or opened or changed as a result of this G7 statement, although not directly mentioned in the G7 statement. But then pops to my mind the question on retroactivity and how to enact this in Europe, because many European countries like Belgium have the principle that the tax rules should be clear at the last day at least of the financial year. So for 2024, the rules should have been clear on the end of December 2024. We are now 25, so retroactive changes to the rules might not be that easy. That will be interesting. And I think, Maxime, we also still have the deadline in Belgium on the QDMTT upcoming quite soon, right? Or is that changing?
That's correct, Peter. Speaking of Belgium, I would say that the situation is of course particularly uncertain, right? Because the first QDMTT return, so for companies or groups with the calendar year end, is supposed to be due by 30 November 2025. So in a few months only, I would say. The last draft version that we saw of the QDMTT return was published back in April, on the 10th of April 2025, sorry. But with all the uncertainty around the OECD guidance and the potential broader changes, it's unclear, I would say, how the Belgian tax authorities will move forward. While, as you mentioned as well, Avi, while ensuring the Belgian QDMTT remains qualifying as such, which is an important aspect, of course. So will they finalize the return as such? Will they postpone the deadline? It's on the table as well to be seen on what they will land. They could, for instance, postpone the deadline for the Belgian QDMTT return to, for instance, 30 June 2026. We just don't know, to be very honest. We just don't know at this stage. And if I would say the OECD were as well to move towards global planning, that could raise even more questions, even more complex questions, I would say. Especially, you mentioned it, Peter, especially around retroactivity. So would new rules need to apply to financial year 2024? Would that stand? What would that mean from a legal standpoint as well? These are for now open questions, and they are creating a lot of uncertainty for groups trying to prepare. So what I would just say is that the coming days will, of course, be very crucial, not only in terms of how the OECD guidance will land, but also in how individual countries like Belgium will choose to respond to that.
Yeah. I would think if I would do a word count in this podcast, the word that would be said most was uncertainty, and I'm afraid that is true. So after multiple years of action on Pillar 2, legislation, guidance, etc., we still are confronted with some important uncertainties. So I would say for today, I think the summary is a bit that there was an important G7 statement. Discussions are ongoing at the OECD on the Pillar 2 on how to deal with this statement and the principles of the statement. So I think in the next weeks to come, more clarity will come. Maybe in the coming days, some new statements can happen, or maybe it will be rather after the holiday period. What is certain is that if you tune in for this podcast, we will make sure you keep the latest on Pillar 2 and other international developments. Thank you, Avi and Maxime, for joining the podcast, and I'm sure I will have to invite you quite soon again in my podcast for a new update. And thank you to the audience for tuning in. Thank you.